Now, looking at the inflation numbers that came through this week, the year-on-year inflation for January at 12.6%. What impact do you see these numbers having on Nigeria's debt assets going forward?
Well, typically the inflation numbers have very little to do with the interest rates on bonds and treasury bills in the local market. Those prices are heavily driven by demand and supply. If you look back to 2010, for most of the 2010, real interest rates were negative, with the federal government bonds and T-bills yielding significantly less than the CPI. So we went back to positive rates last year, but there's really nothing to say that we can't go back negative again.
All right, now looking at that rise in January and expected rise going forward on the short term, the Treasury bill primary auction, which closed yesterday, recorded lower yields than the last auction. Why was this?
Well, I think on the 91 days it was slightly more, but 182 and 364 days saw a significant drop in those yields. I guess many people are pointing to foreign money. Carry traders coming into this market to take advantage of high rates and appreciating naira to get high risk-adjusted returns compared to what they could get elsewhere. But clearly, it's nothing really to do with inflation, and it's definitely not because of the federal allocation numbers.
Looking at the DMO auction for the 70 billion naira in bonds on the 29th of February, was time to take advantage of the release of the Federal Account Allocation Committee between the 27th and the 28th of February. Will this timing have an impact on bond pricing at the auction, do you think?
Well, I think this DMO auction is coming quite late in the month. And the primary reason given for that move, I believe, is driven around allocations. If you remember last month, the auction performed quite poorly, particularly on the 2018, where they sold less than was available for sale. That was partly impacted by the federal allocation having not been released, but also a T-bill auction on the same day. It was quite a good idea to time this auction to be at a point where the federal money comes into the system, and theoretically that should impact rates at that auction.
Looking at the longer dated bonds, what kind of yields can we expect to come through for the October 2019 and the January 22 bonds that are due to come through?
Well, I mean, last month we saw 16 and 16.39 or so. Given what's happened with the T-bill auction, it's very possible that those numbers will be around 16 or slightly less. If, as people expect, some of that federal allocation money gets into the market, and if some of those foreign carry traders still have liquidity in the market, they could potentially push those yields down to 16 or slightly below.
Now, continuing to look at the state and corporate bonds, so far this year we have seen one state bond come through and one corporate bond close. Is this market finally coming back to life after a slow period?
Well, I mean, for the state bond, yes, one state bond came through at 15.5%, 27 billion. That was a transaction that was carried over from last year. For corporate, relatively small amount, 540 at MPR plus 5, floating rate. Some people are coming into the market, but what's quite interesting about those instruments is the way they're priced. They're clearly not priced above federal government securities, which is what was done in the past. Well, the corporate one slightly, but again, it's a 7-year bond, so the spread over federal government is not significant. And people can no longer, the states and the corporates can no longer afford to pay significantly more than the federal government, which is what was done in the past. So many of these instruments are being priced, more or less negotiated between the issuer and the buyers. And it takes slightly longer to close, but they do end up getting relatively better pricing for the issues.
Now, I just wanted to get your view on the naira going forward. We saw it hit an 8-month high on Thursday on the back of hefty foreign exchange supplies from the oil companies and reduced demand from companies importing refined fuel. So what is your outlook for the naira going forward, given that the oil price is currently sitting above that 121 mark?
Well, I think at least on the medium term, between now and the end of the year, naira should trade more or less within the band prescribed by the central bank. Of course, we have to bear in mind that everything all depends on the oil price. Current price of oil is slightly inflated, due to political uncertainties in Middle East. But if the central bank was to be able to manage the reserves in the way they've been able to manage in the past month or two, then the rates should firm up around here or maybe slightly improve. Again, the foreign money is betting on those rates remaining where they are or improving slightly, but only time will tell.